we'll get started. Good morning, everyone. Thank you for joining us again for our asset management training. Again, today we're going to start off by discussing the topic of outsourcing, when that makes sense, what's involved. We're going to spend a lot of time on financial topics today and problem solving. And at the very end, we're going to do a couple of case studies. Because our group size is on the smaller side, we're just going to all stay together in a main group and go through the case studies together. So I think that will work out really well. Katisha, who has been on the prior webinars with us as an instructor, who's just wonderful. I know a lot of you know her. She will be joining us, but she had a board meeting this morning. So she'll be coming in a little bit later and has a segment a little later this morning. So with that, we'll advance to the next slide, and I will turn it over to Kristen to get us kicked off.
And I will share with you all now that unfortunately I have to before the end of our session today. So but as we have talked about before, we'll be able to circulate a list of contacts that include our information, and you should certainly feel free to reach out to me anytime if you continue to have questions or other thoughts as you go along your journeys around this world of real estate. So we are going to start our morning today talking about, and we've talked a little bit about this through some of our other sessions over the last 2 days that we've been together, but when do you want to outsource asset management or property management tasks? Again, very often, right, asset managers for larger properties or for properties that you might not be in the same geography or on site or easily accessible, very often may choose to hire a third party and outsource property management team. And that can be both aspects like I've talked about, you're not local, you're not right there, or just staff capacity. One of the big things I talk about across the board for organizations that are not real estate organizations, that don't do this day in and day out for their livelihood, is recognizing not only the sort of experience and knowledge base, but also just the pure amount of time it can take to manage an asset, keep an eye on it, do the day-to-day property management tasks, do the annual budgeting tasks around the property, do the compliance or reporting that you may have up to lenders or even some of your investor or equity partners. And so really understanding this first one, staff capacity, is really, really important because it takes time. It just purely takes time. And if your mission is to run a school or run a child's care center or a workforce development program, adding in kind of this other project, this other scope of work can just be a lot. It can be a lot for your staff, and it is difficult. While you can sort of pinpoint individual pieces for different staff members, it's just extra. So I really want to kind of reinforce the importance of understanding that, so that you can be really honest with yourself, with if you have a board that you're reporting to, that you're talking to about this, of like what it takes. And really in that context too, kind of opportunity cost. If you have a mission-driven sort of services organization, how you balance the time of the folks that have the knowledge and capacity to provide those services with this separate sort of piece of knowledge and capacity. So those are kind of to me, it's part of why it's number one, is really this capacity piece. Like, do you have the availability? Not just like I can carve it out, but is it sort of the highest and best use of your own time if you're able to have somebody else come in and help? So property management, sort of day-to-day property management stuff, is sort of the biggest core of that. Staff knowledge, like we've talked about, we've gone through a lot of topics that are important in terms of the assessing and managing and thinking about what it's important in managing an asset, and have said along the line too, like experience weighs in a lot. Like you keep learning because you keep running into different situations and different settings. And every time you do that, you bring in another piece of experience. And so folks that have been doing it for longer have had more exposure to more of those settings. That's kind of just the piece of it. So staff knowledge is a place where if everybody in your team doesn't necessarily have any experience in this arena, then being able to bring in that outside expertise and help. Distance, we talked about. Partner considerations, there may be, depending on sort of scale of what properties you're looking at and or the structures, right? If you are doing a low-income housing, affordable housing project with the federal tax credits, then the investor partner, the group that buys those tax credits, very frequently will require you to have a third-party property manager who's got 20 plus years of experience in the field doing that. Will require that you're outsourcing that and not taking it on in-house if that's not your base of expertise. So asset and or property management can be separated. We've talked kind of outsourced. We've talked about what this looks like in terms of sort of the difference of the roles, kind of the day-to-day piece of it on the property management side as compared to kind of the sort of next level up, as it were, in terms of absorbing the day-to-day material, the day-to-day data and information and financials, and sort of making the more strategic decisions around that, or the bigger picture decisions, or the longer term decisions being the asset management role. So property management more frequently outsourced, but asset management teams too. I don't know if Grow America does sort of third-party work, but as Paula had shared, right, she is working with Grow America, and they are being hired by UW or by some of the clients that they helped build properties for, and we're part of that development piece to continue to help manage the assets.
Correct. And we do a lot of technical assistance all over the country as well. So yes, we do provide sort of that third party service to municipalities and such who need some help. And like you said, maybe it's the staff capacity issue and knowledge combined usually precipitates the need for those services.
And there are certain aspects that, on top of sort of asset management itself, are outsourced frequently, right? A third-party accountant is often used to help do the end-of-year audits and tax returns that are required, and sometimes whoever that is may be a more regular partner even in helping support some of the financial reporting requirements or financial analysis kind of from that technical assistance side. So and we've talked about in property management leasing, right? Do you have somebody that is helping during a lease up or specific knowledge around leasing? So there are also possibilities within these. It's not just, oh, I outsource the entirety of asset management, all the tasks and responsibilities, or I have to outsource all of the property management tasks and responsibilities. There can be individual sort of roles that can be pulled in on if needed for specific sort of knowledge and expertise. Next slide. We have talked about this a bit oh yeah, go ahead, Jeannie.
I just was wondering, is it common to have like a master tenant be that property manager as opposed to a third-party source?
When you say master tenant, sort of like a primary, like the largest tenant in a property, that
Correct.
can often be, that is certainly a case that I have seen happen. If you've got somebody who's the sort of major tenant of a building and thus is running a lot of the day-to-day stuff anyway, or has their own maybe facilities person because they've got a large part of a property, then I have certainly seen instances where the owner may work with that tenant to sort of provide that opportunity to outsource and support some of the property management services on that day-to-day piece. Oh, you've got a maintenance guy here anyway already on site. Can they also be hired to, can we pay you to do some of the maintenance or work out something from a lease trade-off? In those cases, what I do still usually see is that the sort of asset management task, the compliance or the review still sits with the owner, right? That level of reporting doesn't sit, because you inherently can end up a little bit in a conflict otherwise in that context of like, oh, who's looking out for the sort of long-term lease negotiations of other tenants, or who's looking out for the sort of long-term bottom line or the compliance on the loans, which is never going to sit with that tenant themselves. Right. But certainly from some of that day-to-day stuff, and kind of being like, here's somebody who's on site every day, and so who provides a filter or feed for kind of questions and information.
No, yeah. That answered my questions. Thank you.
Sure. No, thanks for jumping in. Values, and we've talked about in many, we've covered a number of these things before, right, are really important to be aligned, because whoever you hire and whoever you have, really in terms of, in particular, sort of your property manager is the face to your tenants, to your residents, and having somebody that can align with the way that you want to run a building, how you deal with your community and your tenants and your residents is really important. And again, I think we've said the that aligns both with like the person who is sitting on site, but also the organization that is providing, the company that's providing the property management services. Because I have seen lots of situations where you can have the individual that really align, the individual that's on site sitting with a group of residents who like really gets it and is really in line, but that the sometimes the organization may or may not align with it in quite the same way. And sometimes that just means having really straightforward conversations like, hey, I know your standard company policy is X, but I, as the owner, would like to, give you permission to waive from your kind of company policy of how you do this thing because you're managing my property. And on my property, I would like you to account for things this way. Brian, I see you have a question as well.
Yeah, I had something to contribute in this section just because my organization has taken a slightly different approach to property management to ensure that the property management really reflects our mission. So for a little bit of context, I work for El Centro de la Raza. We're a nonprofit based in Seattle. Been around for over 50 years, and we've worked in affordable housing development for the last about 15. So when we constructed our largest affordable housing development to date back in 2016, it's 112 units. We were, posed with the same question, right? Like, how do we, pursue property management for this large development while still, I guess, maintaining our values and our mission, which is really community-based. And what we ended up doing is we because of capacity, we did have to get a third-party property manager. However, we came to an agreement where the staff working on site are actually staff of El Centro de la Raza, but they are trained by the third-party property management and are given, obviously the I guess the structure of their organization and their company. But by hiring people under El Centro de la Raza, we are able to, one, hire people who, are local to the community, people who, align with our mission, and also, look like the residents, which I think is super, super great. We've seen benefits in regards to lower vacancy. We've seen benefits in also people being more current on rent. And it's just been a beautiful approach where people feel welcome. We see very low cases of vandalism, low cases of crime in our community by residents. So it's something that we recommend if your organization has strong ties to the community. We were happy to hear that property management companies are open to this type of arrangement, and it's been super great. So just wanted to contribute that.
No, Brian, thank you so much for sharing that. And I think that's very true, and in many ways is sort of one of your best evaluation tools of does your company, is the property management team that you're hiring or company that you're hiring, if you are in a situation where that's important and necessary to do, is and can be aligned with your values and willing to align with it, right? And I have even, I know of some firms, and we've talked to some firms in relation to certain projects along that same line, Brian, of even if the property owning entity doesn't have the capacity necessarily, or it's not in a position to be the person hiring those staff members, of still essentially obligating the property management company to still be the employer, but to employ from the community, from folks that have been brought to the table by the owner who were interested in the opportunity, and in several cases have had those conversations even early on in a development project, maybe not that dissimilar from the project you're talking about, Brian, where that you're going to deliver a property and have this staff need down the road, and have been able to encourage property management companies to think about hiring early in so that they have enough time to train up somebody from community who may not have had those property management skills necessarily, but have the lead time, like you've said, Brian, with that structure, sort of they have the framework and the structure and the processes. And so get that training really as part of also providing additional job opportunities for members of the community to, stay and work right there in their neighborhoods. And so, and really that all comes down to what we're about to talk to in the next piece is what kind of a relationship you have with your property management team. Do you have an opportunity for trust, for good communication, for opportunities to bring things to the table and say, hey, this isn't working. This person that you've hired on isn't getting the training that they need to be successful. Hey, this policy that you put in place, as a number of our residents or our tenants have had really stressful or uncomfortable relationships with it, or these are the reasons that we need to change the method at which you're communicating some information. And all of that just, again, comes back to what is that, do you have a good, trusting relationship with open communication and responsiveness that allows you to address those issues? Because those become really the biggest or reputational challenge pieces, is if you're in conflict with the people who are your frontline and or helping advise, then there's just tension. Residents and tenants see and understand that, and kind of that really can mean that conflict sort of grows even bigger than whatever the issue is. So I think, but again, Brian, thank you so much for bringing that to the point, because I think for all the, I absolutely, support all those things that Brian's saying about the property ends up with better outcomes, because you're working with, really, again, what it comes down to is people that you can recognize, people that you can trust, people that you can gain relationship with. And so that serves tenants and residents just in the same way it serves owners. The trade-off can be, and depending, the trade-off comes in how much info, if you cannot get information out of your property manager or asset manager, it can be very difficult for you as an owner, or to make decisions that are important for you to make decisions about, or to ensure that you're staying in compliance with any of the obligations, right? I come back to my responsibilities of an owner. How do you manage your responsibilities? And a part of that is making sure that you have clear communication and clear information and data that you need from anybody that you outsource to. This holds true whether it's a property manager, whether it's an asset manager, whether it's your accountant, whether it's your leasing agent. Just how do you set that up? So really understanding that communication need, what kind of data do you need? We've talked, I think Katisha's mentioned at one point, like you get sort of regular monthly reports. Many of the financial reports and topics that Carolyn's going to go through in the rest of today are parts of information that are typically part of a monthly financial report that a property management team will give you to show you what's going on in the financial picture of your property. And so if there's another, I am frequently working with my property management teams. For instance, we've had a property that has, we're having a challenging time just sort of pricing the units a bit. So when I have a vacancy, instead of just getting the standard report that says there's an empty unit, I am trying to understand, I've asked the property manager to detail for me kind of the background of the rent history, the actual rent history of that unit. So this is not a regulated one. So I don't have fixed regulated rents that are coming out of the city that are sort of minimum or maximum rents. And so I'm looking at the rent history. I'm looking at what the other I've asked them to sort of scope what the other availability is in the marketplace at that moment in time. And I've asked them to, tell me how long and how much interest we've gotten over the last sort of 2 weeks of marketing the unit, because that's what can give me the detailed information to help talk to them about, are we going to give a concession? Do we need to change the time frame? Are we going to drop the rent on that unit? What do we need to do? What are the detailed pieces? And so that is a part of when I'm like, that's just become a part of a monthly report. If I have vacancies, that's now standard for the property management company to be able to provide if I ever have a vacancy, so that I'm not getting a report, seeing there's a vacancy, calling property management saying, by the way, I need this piece of information. 3 days later, oh, can you also tell me what's going on in the market? Okay, 3 days after that, and trying to kind of chase down a scope of information in order to be able to make a quick decision. Because what I want to be able to do is, in response to that monthly report, when I see there's an empty unit, is say, okay, here you go. It's what you've given me is the data that's telling me what and why and how it's hard to lease. Let's take these actions. Let's put it on with, a concession that if it leases by the end of the month, you have a half a month free, or something like that. It just provides the tools. So in the owner position and the asset management position, I can make quick and informed decisions to sort of direct what needs to happen at the property. We've had properties with a more extensive AR, and so similarly, accounts receivable, folks not being able to pay rent. And so similarly, what I've asked for is, instead of a report, just the accounting report that documents that numeric amount of what is overdue, is a note section. This property, we take we really try to understand what's going on for individuals, set up payment plans as it's needed. And so I asked for a note section that the property management team is sort of writing notes for when I see it in that monthly report, to understand, oh, that's somebody who's just had a medical crisis and we've set up a payment plan. So you're going to see the arrears, but we are in communication with and addressing that tenant. Again, what that means is I've got sort of a standard set of information that I can use to assess. And that's all just come from a back and forth with the property manager saying, hey, instead of me kind of pinging you after I get this thing and having to chase down a bunch of information, if you can provide this as part of a standard bit, then I can quickly provide details and answers and actions back to you as needed, because it gives me what I need to mitigate risk.
And I think, Kristen, that harkens back to what we've been talking about, which is for asset managers to understand the expectations of the stakeholders, so that you're not seeing a receivable balance and wondering and having to reach out every month. You made it very clear, this is what I'm looking for from you every month, and this is what's helpful information to me. So, in addition to that, there might be other key points to be included in a narrative, maybe budget variance explanations, or information about events coming up, or maybe competition coming into the area, just sort of picking out some of those other items that we've talked about and just telling the story each month of the property, in addition to having the financial reports, which obviously we're going to be looking at today, is very, very helpful. And, you want to be able to be very thorough, and with also from a self-serving sort of perspective, able to move on to the next thing, that you're not going back and forth with, an internal owner, external owner or stakeholder, that you're hitting the mark and you're able to move on to the next thing without always having to go backward.
Yeah. And it doesn't mean that you guarantee that it. This says sort of structuring the contract. It doesn't mean like, oh, if I didn't realize that when I signed my property management agreement, and here was the list of reports that I asked you to give on a monthly basis in my property management agreement, it does not preclude you from going back and saying, hey, I also need you to do this, right? And if you have that open and honest communication with your property manager, and what you're asking requires a ton of extra staff time or something, they, hopefully are in a position to say, hey, that's going to take a lot more from us. We are happy to do it, but we may need some additional compensation, or we need to talk about, the staffing plan, because we prefer that be done. Ideally that's done by somebody who's on site and has that immediate access. So how do we make sure that we're not overburdening an on-site property manager with tasks, and you filter through. But the goal is really to get to the place where you have the tools you need to assess the risks and sort of maintain the decision, make the decisions in a prompt and sort of efficient, an efficient enough manner, so that if there's a conflict or something going on at a property level, it's not dragging on, right? You can be in a position to clearly know and help direct. And similarly, like if there's a question, kind of working your way up or down the chain, if there's a question from a lender or something, you can be responsive and not create a setting where, if you're a third-party asset manager hired by an owner or your lender or your investor, that you're able to give sort of prompt responses and help make decisions because you have the context of what needs to happen. Are there any other questions about thinking about sort of third party and when you might outsource or when you don't? Again, this becomes really a very particular to each individual context of what your property is. Are you an owner occupier? Are you a tenant? Are you commercial? Are you residential? But these, hopefully we've covered sort of a variety of the core things to think about when you're evaluating your own context. Carolyn's going to move into our financial topics now again, and as we've said, I think as she digs in, and it will be a lot about the numbers, understanding the story that's being told by the numbers, and when necessary, asking your staff, on-site staff, property management team to give the narrative context to those stories is often very helpful, because I frequently find, I can find myself looking at a set of financial reports and go, I can derive 3 different stories from what I see in this financial picture. I can see that, oh, maybe my water line has gone crazy. It's been really variable. And I can think, okay, there's a problem. There's been a leak. There's a leak that nobody's noticing and something's going on and I don't have information. I can derive the story of their seasonality, right? Is if I look closely enough and if I think of, if I can understand the timing of billing, well, maybe this is just because those bills seem high and they didn't hit right in the summer, but I had a high irrigation need. And so I was using more water and, but the bills didn't show up until September and October because my water company lags. Or I can see that, yeah, I've got a set of tenants that use water in really varied ways, and I don't know which of those are. And so the first one is a risk, right? If there's a leak, I want to get it fixed because I don't want to be paying for water that's just going straight down the drain. I had a commercial property in downtown Seattle where we found that there was a pipe that had a leaking valve, and it was in the wall. We didn't there was a valve that had been open. We were literally running water into the building and right into the drain out to the sewer system. Never got touched by anybody in the building. And it had been doing it for probably a year and a half by the time we finally figured it out and found it, right? So, using your numbers to figure out problems can be particularly around utilities. I'll tell you, that's one of the biggest places that, you highlight if you're like, there is no reason this water bill should be changing. That's that. But that's where you rely on your team to help bring the story to light and matching. So you might be asking questions about the variability and having your team help assess and share the specifics of what they think the narrative is around those numbers.
That's a good example, Kristen, and a good lead in.
Yeah.
Switch to the next
to problem solving. Yeah.
Yes, exactly. You've hit the financial topic and the problem solving. So we have 2 big sections coming up. Financial topics, as Kristen mentioned, is our next big topic. We'll be spending a good amount of time on that. So we're going to talk about financial analysis a bit, budgeting and considerations when you're budgeting, and certainly how capital expenses play into your immediate financials as well as your budget preparation. The next section after that, which will be a little bit from now, but Katisha will jump in and she'll be back obviously on the webinar to talk about problem solving and how you figure out how to take care of trouble in paradise. So she'll be going through some early warning signs that a property needs attention, and being a property detective. So what Kristen was just talking about, getting your nose into it and figuring out when things aren't making sense and what some of those remedies might be. So that's a good section as well. Next slide, please. So from a financial analysis perspective, I'm sure you guys have heard this term before, but cash balances are very important. Cash is king. If you don't have cash to pay your bills, your property is immediately in trouble, and you don't have cash for a number of reasons. And again, that's something that needs to be investigated. Really an easy example would be, high vacancy. If you have high vacancy, there's a cumulative effect over months of that on your cash balances, on your income statement as well. We need to take a look at what the reserve requirements are. And again, I know some of these things we've talked about before, but we're just trying to reinforce, the importance of some of these financial topics. But, certainly if you're not funding your reserves the way that you should, you could be out of compliance with covenants with your lender. Certainly if there's an investor, they're not going to be happy that the reserves aren't being funded. And again, when we think about reserves, we're really thinking about, reserves for the long term. We know these days appliances don't last nearly as long as they did 20 years ago. If you get 7 years out of a refrigerator or a stove, that's considered good. So you've got to make sure that you're putting money to the side to make sure that the property, when it has needs coming into the future, that you've got the cash there, that you don't have to worry about that through operations. A rent receivable report, very important, as Kristen was just talking about, to be able to glance at a report and see where folks are with their rent payments. A good format for a rent receivable report is not just something that shows, current month rent and balance. Certainly, you can do the math, but what's easier is if there's a format that you can use that shows you the aging, because you can just very visually go down the columns of 30 days, 60 days, 90 days and over, and really gives you a sense, aside from the total number of dollars in the receivable column, really how old that is. And that can generate some questions. Accounts payable, if your bills aren't getting paid, it's a problem. You're not going to be able to get third parties to come to your site and do work when it's necessary. We have some properties that we recently invested in. 3 of them are in Ohio, and unfortunately, the owner that was in place prior to the new owner that we're working with and our partners with just really stopped caring. The long and short of it is they stopped caring, and they stopped paying their bills. And these properties are in small communities, kind of where everyone knows everyone else. And the landscaper wasn't paid for an extended period of time. So all the landscapers in town, not that there's that many, but they know that they're not going to get paid if they work at the property. And even if you reach out and explain it's a new owner, that sometimes doesn't erase that history. And unfortunately, with this property, even with the new owner, there was, a new property management company. They didn't pay the landscaper. So now you have, your story has worn thin, and they're struggling to get someone to come and cut the grass. And as we know, curb appeal is very important, and having, nicely cut grass is one of the lowest hanging fruit that you can get to. It doesn't take a lot. It takes more money. I'm sorry. Did someone have something to say? Okay. If you're going to redo the whole landscaping, obviously that's very expensive. And not that keeping the grass cut is cheap, but it's a lower hanging piece of fruit, definitely. So review the accounts payable report, know what's out there, come up with a plan to make sure that people are taken care of. One of the other problems we see is even with third party, maintenance services of other kinds. We'll see where folks will, go from one HVAC contractor and use another one, if they're not able to pay the first one. And it just creates all kinds of issues. So you just want to make sure that bills are getting paid, of course. And then, looking at the performance, how is the property performing on a monthly basis compared to what the budget says? And again, the budget isn't some mystery. The budget is a plan that you've been part of to make sure that that's realistic. So where are things going off track? As Kristen said, sometimes it could just be a timing issue with how certain expenses fall throughout the year. It could be a situation where, there's a lag, as she said, in getting a bill, or you could think that you're doing really well on maybe your water and sewer, and you think that you're really under budget for the year to date. And the reality is that a bill wasn't received. And so now you're having a catch up, it just gives you a different view from what really is going on at the property. So just kind of going through all of those things on a regular basis is very important. Another important financial topic is the gross potential rent. So gross potential rent means, and I'll give a very simple example. You have 10 units and each unit rents for $1,000 a month. So that's a gross potential rent. If all the units are leased at the amount that they should be leased at the market, whatever the market is determining or your restrictions are determining, that's your gross potential rent. So say that's, $10,000 a month, then using that example, versus what is the actual rent that you've achieved. So you're looking at your financial for the month, and a simple mathematic analysis would be you have 9,000. If you look, and sure enough, there was one unit that was vacant the entire month. As we all know, it's usually not quite that simple. It's a combination of things, maybe partial months that aren't there. But again, just really understanding where that lack of revenue is. And is it because you have the vacancies and the units haven't been turned? If they haven't been turned, why haven't they been turned? If you normally turn units internally and you have a lot of units to turn, maybe you need to look at outsourcing some of those unit turns so you can get caught up, because your maintenance staff is obviously overwhelmed if they're trying to keep up with, sort of day-to-day normal maintenance, plus do the unit turns if there's been a lot of bouts. We talked about this actually with one of our partners for a project that's in Michigan, and it's a large project over 200 units. So when you say there's 17 units that are vacant, I guess it's not horrible. You wouldn't want to have, you don't want to have any vacancy, but 17 is a big number for 2 full-time people who are also trying to take care of so many other things. And it just seems so simple, but yet we had to have a conversation with the regional manager in this case, to really discuss that and make that recommendation. And, her response was, oh, well, I told them that a month ago. Well, okay, it's not happening because we just talked to them. So, is she being in touch or as close to the property as she needs to be? It sounds like she wasn't. If she's looking at the reports and still seeing this vacancy, clearly she just wasn't, dialed into what the reality is. So unfortunately, we did need to bring that to her attention, even though she should have known it herself. And that's what you want. Like, you want to make sure that if you're in the role of making sure that these things are happening, that you're looking at those options, because again, you multiply that amount of rent out, just get somebody in, get these units tenanted, get the rent rolling back in, get your bottom line looking a little bit better. Cash flow versus accrual financial statement. So there's different ways to present a financial statement. And the cash basis is probably the most simplistic way to look at a property's operations. And a cash basis statement means that whatever rents you collected, and say it was $8,000 for the month, $8,000 is your revenue, and you open up your checkbook, and I've written 10 checks that total $6,500 for that in that month. So my net income is $1,500. So very, very simple, right? Documents that you put your fingers on, easy to understand, but that doesn't really give you the best picture of the operations of the property, because you could have expenses within, let's use November as our example, but we can have expenses within the month of November, and you get the bill in December, but it really related to November. So you had maybe your fall cleanup of your landscaping that happened in November, but really you're not showing it on your financials until December when you actually get the bill. Whereas an accrual statement means that you're trying to align revenue with expenses for that current month. So your revenue would be recognized not at the revenue that you've collected for the month, but it will be recognized as the amount of rent that is billable or due for the month, regardless of if it's been paid or not paid. That's a separate topic. And the same is for expenses. So your person who has done your cleanup for that month, they're billing you, they're going to bill you $10,000. You know what that amount is because you've signed a contract with them. You're hoping to have the bill, but you don't have it. You might want to go ahead and record that so it's recorded in the proper month. Or, maybe it's real estate taxes, I think is a good example where, generally you're going to pay real estate taxes. And I'm not sure how Seattle is. I think it's twice a year. Most places, most states or counties are, but you're paying real estate bills twice a year. So if you're in a cash type of statement and your real estate tax bill is, $10,000 each time you pay it, the months that you're paying that bill are going to look terrible. They're going to show probably, a net loss instead of net income. Whereas if you take the amount that you're paying and you divide it by, 6 in this example, because you just made the payment for, one period of time, then you're really allocating the appropriate amount of expense to the appropriate period. And it sort of levels everything out. And, when you are presenting information and trying to compare against a budget, trying to do that against a cash statement is really impossible because you're not capturing expenses and income in the right period. Accrual financial statements gets everything aligned for you and should align pretty closely to your budget. So, and we will talk about budgets again just in a little bit here, but if you remember from last time, we talked about the idea of having, your budget being, each month and then you have your year-to-date and some comparisons after that. But booking and showing your expenses and showing your revenue against that budgeted amount for the month of November is going to give you the most accurate representation of how you actually did for that month. So I'll pause here for just a moment. Are there any questions on any of these topics? Not yet. And again, if you think of something, you can always raise your hand or jump in. We certainly don't mind. We can go to the next screen, please. So we were just actually talking about part of this, about the fact that the income statement is your report that's reflecting revenue expenses for a set period of time. So again, it's periodic. It could be for the month, it could be for a quarter, but it's always good to have a year-to-date column regardless, so that folks can look at that and see where you're trending for the year. And again, a measurement against that budget number really is optimal. And a lot of financial accounting systems will give you, a lot of options. So if we're thinking about an income statement, there should be an option to have a very detailed income statement. And we looked at one of those very briefly on Tuesday, where you see every line item. Say for utilities, you'll see each line item for a water sewer line item, a trash line, a gas, electric. But then there's also representation on a summarized basis, which would group all of those expenses together into one number, which would just be utilities. And the reason it's good to be able to produce both types, so have your detailed statement roll into a summarized statement, is that you might have different folks looking at these reports, and someone at a higher level just doesn't want all of the minutia. They just want to know, here are the categories, here's what you said you were going to do, here's how you actually did, and here are the differences. And yes, things look good, or no, things don't look good. But if you have a line item on your summarized that is really out of whack, you can go to a detailed statement and you can really, it breaks it down. So you can really see where things might be off. And from an asset management perspective, you really want to focus in on the minutia, so to speak. You really want to be able to go line by line and just make sure that things are matching up. Because if you have, say, $1,000 a month for office expenses, and all of a sudden you can drill down to that line item and see that way too much is being spent. You have somebody who loves to order from Office Max. You can really put a hold on that before things really get out of control. But when it's rolled into one number, overall office expenses, you may not be able to see that level of detail. Next slide, please. So just a little side note on funding sources. We talked about income being rental income, and that's very simple. And certainly you have potential for having some miscellaneous income. Maybe you're going to have laundry income. Maybe you're going to have some kind of reimbursements. Maybe that you're billing back the residents for their prorated portion of some of the utilities if you don't have individual meters. So you might see some other miscellaneous kind of line items. But you also could have some different funding sources that could impact the economics of your deal. So a grant is where someone has within maybe the development team, maybe you've done it, but there are dollars coming into the project in the form of a grant, which means we say no strings attached, but there are. But by no strings attached, we just mean the dollars come in. They generally do not need to be repaid. It is, when I say it's a gift with expectations generally. So we were talking about some social service topics on Tuesday. So that's a good example of a grant, that maybe you have that $50,000 grant coming in and you have some expenses against it. You could also have some reporting due back to whoever's providing that grant to you. A subsidy is a little different. A subsidy might be a rental subsidy. It could be something else to help the residents to bring down the rent. But usually there is a covenant, meaning you've got to be able to provide something at a certain price once someone gives you dollars to write it down, if that makes sense. Or you are getting a subsidy because your project has maybe a community room that you're opening up to the community, not just to the folks who are residents or tenants of your building. So there is, a give and take in that situation. And if you don't perform or you don't do the things that you're supposed to do, you know, there usually is some sort of recourse where that may need to be repaid, or certainly it would end. A loan are dollars coming into a project that, you know, generally will require repayment of principal and usually interest down the line. So there are a number of different types of loans. You know, we refer to loans that need to be repaid as hard debt, meaning that they don't go away until they're paid off. You generally will have a monthly principal and interest payment, just like you do with your home mortgage. But there are also loans that are, you know, secondary or soft loans. They might be listed as second in line or third in line, but some of those loans that we see in affordable housing don't always require repayment. You know, they might require repayment if, you know, there's a covenant that says, you know, you need to provide this as affordable housing for so many years, and all of a sudden you just stop doing that somewhere before that term has expired, and then all of that could be due. And it might be due back, well, obviously the principal's due, but there could also be interest that's accruing that would be forgiven if you do everything you're supposed to do. But if you don't, you're going to owe the interest as well. And a lot of those loans we see will have either a very, very low interest rate. Oftentimes they will be at 0%, which is even better. And those types of dollars coming in really help you to be able, in the instance of affordable housing, provide the rental amount to the residents at a much lower rate than you would have otherwise needed to if you had a higher hard debt number that you needed to hit. Next slide, please. So what goes into a profit and loss statement? So we've been talking about this. This is a good visual for us here. So we start with our total income. And from the total income, we're going to reduce that by the amount of operating expenses to come up to our net operating income. So in your total income and revenue section of your statement, which is always at the top, you'll see rent. Again, maybe there's some fees that you're getting or reimbursements. The expenses, obviously this is a very, very short list, but you know, there's some general expenses, which could be, you know, your operating expenses, legal and audit, perhaps. Maybe you're paying rent for something. Maybe you're renting the laundry equipment. You could have common area utilities, even in a situation, obviously, where folks are directly metered, you still will probably have some common area utilities. Building maintenance, you've got your property taxes and insurance, and there's always going to be some level of administrative expense. So office salaries, office supplies. Again, a very, very brief example, but just to give you the idea of the differentiation between the two and the fact that you're, you know, deducting your expenses from your income. And I always, if people feel like a little confused about this thought, I always recommend just go back to thinking about it like home, right? Your income is your net income that comes from your paycheck. Your expenses are all of the expenses it takes to run your household and pay for food and all of that. And what's left over is either your net operating income that's positive, or you have a deficit, unfortunately. So no Dunkin' Donuts next month for anyone. But this will get you to your NOI. Taking your revenue and deducting your expenses gives you your net operating income. But you don't stop there, because we talked about the fact that, you know, most buildings, whether it's commercial or if it's rental housing, you know, there's going to be some level of debt service. So you need to deduct the debt service that needs to be paid from your net operating income. And then that shows you what's really left over. At the end of the month, you know, we've run the property well, you've paid your debt, you've paid your bills, and here's what's left. So again, we mentioned before that maybe the owner would have an expectation of some sort of a cash flow distribution depending on the type of project. So, you know, understand what that is. And were you able in this month to achieve whatever that goal was that was already set in advance? Next slide, please. So how do we, you know, we talked about kind of going through and looking like line item by line item at expenses, comparing it to budgets. Maybe you're comparing it to prior period, you know, November of this year to November of last year. But what are some of the other sort of metrics that you can be looking at? So DCR is the debt coverage ratio. You may also see this DSCR, debt service coverage ratio. They really do mean the same thing. And it's your ability at the property to service the must-pay debt. And we're going to talk about DCR, do actually some calculations a little later. Break even is the point where you have just enough revenue coming in to cover your expenses. So, you know, is that good? Like, okay, yes. I mean, you want to be able to cover your expenses, but, you know, ideally you really, not just that you want to operate above break even, but you really need to, because you need to be able to have the funds set aside to maintain the building again for the long term, excuse me. So in order to do that, you just need to make sure that, you know, you're above break even. And again, most of your lenders are going to have, you know, various covenants in the loan documents. And the big loan covenant is the DCR. And the DCR will be called out in the loan covenant, and it might be a 1.15 or 1.2. And again, we're going to look at some examples of those, but if you're just breaking even, you're not meeting that loan covenant. So you're going to have trouble with your lender or lenders if you're operating at break even. That's not sufficient. And what is the difference between NOI versus NI? So the previous slide, you know, we looked at revenue minus those expenses, and we said that that took you down to net operating income. So that's the amount of income that is being derived from the operations of the building. So things that as an asset manager and the property managers have control over, some things. Some expenses are fixed, which means you don't have control of them. Others are variable. So a good variable, I think, expense would be, say, a utility bill. Like you kind of think, well, it's fixed because it exists every single month. But in reality, it is variable in the sense that, you know, it could be a different amount depending upon weather, whatever, how many folks are in the building. If you add new lights to the parking lot, that's going to affect your electric bill. So, you know, it's a little bit on the variable side as well. So again, NOI measures that revenue minus your ordinary operating expenses. Net income starts with that number, and then from that number, you're going to deduct the debt service payments, and sometimes there are partnership fees. Sometimes there are partnership management fees that need to be paid. And sometimes there are taxes which need to be paid for the partnership. So as an asset manager, thinking about the property doesn't really have any control over that. But it certainly is an expectation of ownership that those expenses are covered. So when you deduct those expenses from the operational or the net operating income, that brings you down to net income. At the end of the day, sort of what's left. But where do those reserve requirements fit in? So we talked about those before. Mostly we're talking about replacement reserves, because generally speaking, an operating reserve is sort of set up at the beginning, but you could have an operating reserve goal. Maybe you're trying to increase the amount of operating reserve going forward. So where does that all fit in here? You know, and the important thing is to understand where the owner wants it to fit in and where the lender expects it to fit in. So there's a place called, or there's a line. So you might hear people say, well, that's an above the line expense. And when somebody says it's an above the line expense, what they really mean is they consider that to be an operating expense. So it goes at the top above where you're calculating NOI. So if you come down to a calculation of net operating income of, say, $10,000, but your lender and owner expect that the replacement reserve is really funded out of operations, which is honestly the most common way that you're going to see this. And maybe that requirement is $5,000 a month. Now your NOI has really been adjusted because you're accounting for the funding of the replacement reserve above the line, again, above the line meaning from operations. If somebody uses the term below the line, then they mean below NOI before you get to the calculation of net income. So you've come to your NOI, you've deducted your debt service, you've deducted any partnership expenses, you're deducting the replacement reserve amount there, and now you're coming down to your final net income number. So again, just understanding, And people have different ideas about these reserves and where they should be. But ultimately, there's going to be a document that is going to tell you where it needs to be. Because the last thing you want is for you to believe that it's below the line, but your lender is calculating it above the line, because that's going to change the calculation of the DCR and could mean that you're rolling along thinking that you're meeting the DCR covenant, when in reality you're not, because you're calculating it a little differently. And I know sometimes it takes a minute to really think about that. Brian, did you have a question? Or want to say something?
Yeah, I just wanted to understand the difference between net income and cash flow. Are we talking about the same thing?
You know, it could be the same thing, but technically it's not. And I'll tell you why it's not. Because I'll use the example again of the replacement reserve. So if you are funding the replacement reserve and actually paying it, putting it to the side, so it's not really an expense, it's just part of your calculation, that is going to the side and it is part of cash flow, right? So in this instance, your net income is going to be reflective pretty much of cash flow, as long as everything has been paid, if that makes sense. And Kristen, I think you're coming here in just 1 second. But also, even if you haven't paid it out, so the cash hasn't been expended, it still is going to get recorded and be a reduction of your or impact your NI, your net income. So that can be a little bit of a difference between NI and cash flow in a simplistic standpoint. Kristen, did you want to jump in?
And just, I think what the terms end up being focuses at different times, right? If you are running your day-to-day property as the property manager, the person responsible for paying the bills, you're very focused on actual cash flow, right? Like,
correct, right.
All the time is, how much money do I have in the bank, and can I
Right.
write the check for the water bill, right? And so that's when you're really looking at cash. When you are doing your financial reporting and accounting for investors, they're usually looking at accrual basis. So you may be recording an expense like 1/12 of your insurance bill, even though you haven't written for the check for the insurance bill yet. And your lender, Carolyn's talked about sort of debt service coverage. Your lender, you may have covenants or responsibilities to maintain a certain relationship of your net operating income to your debt, not necessarily your cash to your debt. So that, your legal documents, your loan agreements are going to talk about net operating income or net income. So those are it's sort of depending on, there's very much a focus on what perspective are you looking at it for in terms of which sort of metric are you using.
Okay. So
is that helpful, Brian?
Yes, from what I understand, it depends the context and kind of like your role. It sounds like okay.
Right.
Cool.
Yeah. Exactly.
And you, right, financial statements, right, can be reported on a cash basis or on an accrual basis. Which I don't, Carolyn, I can't remember if you're kind of getting into the detail of that, but right, your cash basis is going to tie and tell you how much cash you have in the bank account at that, at that moment.
Exactly. It's a very simplistic view, again, aligning income, dollars in and dollars out. And here's the difference. And that ties back to that cash is king theory. And I think this is why it's very confusing sometimes for folks to understand, because if you're looking at an accrual statement, again, a statement that is aligning the realities, aligning what the rents were that were billed, regardless if they've been collected or not, and aligning the expenses. And Kristen used a good example of the insurance. We talked about real estate taxes before, and you come to a bottom number and say that bottom number is $5,000, and folks want to know, well, where's the $5,000? Well, from that perspective, that isn't, there's not really, there can be a correlation. There's a cash flow statement, and I don't want to get into that. That's a little beyond what we're trying to accomplish today, but it would sort of take that bottom number and it would minus out changes in payables and receivables and account for some of those differences to come down to a cash number that makes sense. Like, how much have you added to the cash balance this month? But from a simplistic standpoint, it makes people, I think, pull their hair out a little bit, because you're looking at your checkbook And again, you've got maybe 3,000 in your checkbook, and it's like, why don't I have the 5,000? And the difference is because of the presentation of the financial statement. And that's why in some ways, from that simplistic view, a cash flow statement is just the easiest way to understand, in the sense that if it comes down to you should have $3,000 left at the end of the month, you can look at your bank book and you're going to see the $3,000 plus anything that was coming in from the prior period. Whereas with the accrual statement, it gives you that better alignment of expenses and income. So you can see really from a performance perspective how a property is doing, but it doesn't correlate exactly to what's in the bank book. And that's where that other statement of cash flows can come into place. But that's what gets people a little bit tangled up, I think. But ultimately, when you want to figure out cash, a cash flow statement gives it to you plain and simple. But if you really want to have that better picture, and when you're dealing with taxes and things like that, an accrual statement is what an accounting firm is going to use to prepare the taxes. So.
Carolyn, your even sort of the personal checkbook example is a really good example. It's sort of like also a way to think about it, right? Like if you are figuring out, can you afford to rent an apartment? Like you do the math, what do you make over the course of the year? What's the, what do you make each month, and can you pay that rent? But say that, so that's kind of the accrual. That's the net operating income vision of it. Sometimes, very often, sort of the way to think about it too is, while we're looking at month over month financial statements, the net operating income is the number you're thinking about on an annual basis, often for a property, right? Regardless of the up and down and flows of the actual cash. In the big picture, this is what I think I'm going to get over the year, and this is how much debt I have to pay over the year, and these are my expenses over the course of the year, over these bigger, longer periods, sort of more of the asset management picture. And so great, you figured out that you can rent this apartment. What happens, rent's due on the first of the month every time. And what happens when, the last day of the month is usually when you get paid, and it falls over a weekend, and now you're, the first is on a Saturday, and you don't end up getting paid until, the following Tuesday, but your rent was due on Monday, right? Like
right. So
you didn't have the cash,
exactly.
like you didn't have the cash deposited in your bank account to write the check for the rent, right? So you're having to figure out how to manage that if that relationship of that income is directly tied to your ability to pay that expense. And so that's why the example of the taxes or the insurance are kind of, if there are going to be these big numbers, they get paid that wouldn't, that all of a sudden on a cash flow statement that month, you would be negative, because if your insurance bill is $100,000, but you only take in, $60,000 of revenue in any given month, you're not going to have $100,000 in that month to pay that insurance bill unless you've kind of been saving up for it, accruing for it. And so those are the decisions that you're helping look at and make.
True. Good.
Is that helpful to everybody? I think it's like, it was really a piece of understanding of my own learning and training, how valuable an accounting class was to my ability to be actually a good sort of steward of this, was trying to understand the differences in these statements and what I was looking at and what did it mean. But
and I guess it is very common, like I said, to feel like you're getting tangled up in it. And if you feel like you're at that point, again, just kind of take a deep breath and just remind yourself that when you're thinking about a cash statement, think about your home finances, money in, money out, cash minus, plus or minus at the end. And then the accrual statement is where you're aligning income and expenses for that month, aside from what cash, aside from the cash piece of it. So anyways, just take a deep breath and you'll be fine. But it takes a minute. And I have had colleagues that, have been in business for many years, have taken accounting classes somewhere along the way. And, once in a while, they'll just have to stop. They'll just have to take a minute and just really, think about it, especially if it's not something that you're thinking about every day. But asset managers do have to think about this very, very often, very regularly. Okay, we'll go to the next slide. Okay, the debt coverage ratio. I'm going to go off camera just for a minute because I have a lot of notes I need to look down at to make sure I don't forget anything. So excuse me for that. I'll be back on shortly. The debt coverage ratio, why is it so important? We've already talked about the fact that it is a a covenant in your loan documents. And I'm going to show you briefly how it's calculated, and then we're going to be looking at some examples. But, to start off, we really need to get to that net operating income number that we talked about before. So again, that was before net income. That was taking and it's right on the screen, your gross rent minus any vacancies gives you your, sort of your net rent or effective gross rent. And then you're subtracting all of your operating expenses to come up to your NOI or net operating income. And if you remember from the earlier screens, we're going to deduct some things from NOI. We're going to not think about partnership expenses at this moment. But in this example, to calculate the NOI, what you're going to do is you're going to take the NOI that's calculated above, and you're going to divide it by the amount of the debt service, the required debt service for that month or for that period. And again, going back to reading documents and understanding how calculations are made, some lenders will want a periodic calculation, meaning, say they're looking at the quarter. They want to know your net operating income for the quarter, and they're going to take that number and divide it by the required debt service for that quarter. So 3 months worth of payment, so to speak. Or an easier example is just the 1 month, right? But in reality, the way that we're calculating it at Grow America on our investments, and most lenders are calculating it, it probably is on a year-to-date basis. So when we're doing our calculations, we're looking at that NOI, period to date. So right now we're in the middle of making calculations for the end of third quarter, and then dividing it by 9 months worth of debt service that's required. So again, that's principal and interest. In other words, the full payment. And again, focus on the word required, because as we talked about before, not all debt has a required periodic payment that's due. So that soft debt that we talked about previously is not included in this calculation. Once you have this calculation, you should already know from having read the documents what your lender is requiring. And again, I mentioned before, we generally see a 1.15 or 1.2. So if it was a 1.0, that's your break-even point. That means that you have just enough revenue coming in to cover all of your expenses, including your debt service. But you want to always have a buffer, because what if you get to the next reporting period and something has happened, the neighborhood's changing, you have a lot more vacancy, you're not going to be able to meet that requirement. So that is an issue. You want to make sure that you're above that 1.0. You want to make sure that you're in a very healthy range. So if your lender's requiring a 1.15, the higher you are above that, the better. We have quite a few assisted living projects, affordable assisted living projects within our portfolio. And some of the DCRs that are calculated for those projects are astronomical. I mean, in the 6s, in the 7s. We also have some senior projects that calculate out, in the 4s and 5s. So, well above whatever the covenant may be. So a really nice buffer. From an asset management perspective, a lot could go wrong at a property with a DCR that's that high before you would actually get into trouble with your lender or not be able to pay your bills. And we have some assisted living projects that I'll use the COVID period. I know we're tired of hearing about it, but during COVID, of course, there was a lot of concern in assisted living projects because, generally speaking, families were very reluctant to bring their family member who had needs into a project like that, because they knew that once they crossed the threshold, there was going to be some undefined period of time before they would be able to see their loved one again, because there was restrictions on visitors. Obviously, we understand why that is. So if there was a vacancy, if someone passed or they had a higher acuity need and needed to move on to a hospital or a nursing home or something like that, the vacancies kept increasing over time. And we got to a point on a couple of properties that they were only at like 70 or 75% occupancy, which at most traditional commercial and residential properties, that would really be a catastrophic range of occupancy for an extended period of time. But because those types of properties, the way that they're structured, and their rent levels and such, and their high DCRs coming into it, and high cash flow that was accumulating because of that, they were able to weather that storm. We really didn't have problems with any of them, other than one that was having problems for a different reason. But we're talking about probably 15 projects at that time that were really suffering occupancy wise, but didn't need to go on our watch list because their DCR and their cash flow was still positive. So anyways, a lot of focus on DCR. We're going to go through a more specific example here. We're going to look at some numbers in just a minute, but again, you just want to make sure that you've got, some sort of a buffer, and, maybe your DCR covenant is 1.15 and you're at 1.16, and you're like, oh, I'm going to buy something. Maybe I want to replace that corridor carpeting or something, or, buy new furniture for the lobby, whatever it is. Like, don't think that just because you're above the covenant that your loan documents have that, you could just pull out all stops. I mean, you always want to be very thoughtful about expenses, even in situations where you have good cash flow and you have a good DCR. You've got to always just be thinking about the future. And if I can say one last thing about COVID, I think that that's really a lesson that we all learned, even on a personal front. Like, you just don't know what's down the road. And as an asset manager, you want to make sure that you're really protecting that asset, again, not just for today, but for the long term as well. Okay, next slide, please. I want to talk about, a couple of different types of loans here. So when we're talking about a construction loan to either rehab of existing property or to newly construct a property, you're going to see generally a construction loan to do that. And generally construction loans, through whatever source, generally commercial banks, are considered to be very short-term financing. It's really just intended to help you pay the bills, to construct the property or to rehab the property during that set construction period. So they're usually actually written to be less than 2 years in duration. So again, to finance all the costs while the project is under construction. And at the end of the construction period, the source to repay that construction loan is generally repaid from the various permanent financing sources. And there could be multiple permanent financing sources that will pay down the construction loan. If things do happen, we've seen over the last few years, labor shortages, components shortages, especially things like switch boxes, electrical. For a while there, it was hard to get appliances. I mean, there was a whole list of things that we were dealing with. So we did start to see some construction projects that were really still going on when their construction loan was coming due at the end of 2 years. And, lenders were very, I think by and large, very understanding during that time period, especially. And so you usually can get an extension of a construction loan. They're normally extended in 6-month increments. You can have multiple, renewals or extensions, I guess I should say. But there's usually a cost associated with that. There's no such thing as a free lunch, right? So usually there is some sort of a fee that you're paying in order to get that extension put into place. But, again, and maybe this isn't under your umbrella, it's maybe your development team or something, but, it's not something that you want to wait to the last minute. Communication, again, is very important. And usually your construction lender is very in tune. They're receiving construction draws generally to be paid out of the loan proceeds. So they know what's going on. There's usually a lot of communication during that time. And banks, I was going to say banks really love to make construction loans. When I say that, what I really should say is that the construction period or the development period really is seen as a period of time where there's very high risk, right? Because the asset is not complete, it's not generating revenue. But if you have your permanent financing sources already lined up, it's really it's a comfort. And usually a construction lender, they want to know from the beginning how they're going to be taken out or how they're going to be repaid. So even though that period of time is high risk, from a construction lender's perspective, I would say that there's a little bit more of a comfort level because it's a shorter term relationship. It's very profitable for the banks, and they know that they're going to be taken out. Kristen, I don't know if you have any examples of maybe something contrary to that, or something else to add to that piece.
Not specific.
Okay, that's fine.
Yeah.
That's okay.
I think that, I mean, just in the case of what we are seeing more and more, are more variations and layers of different kinds of financing in our environment, particularly sort of programs that have come together for lending for specific needs, like lending around childcare and opportunities, right? The state and enterprise have come together, and they have and the Washington Community Reinvestment Association have a product that is a loan that can be used for construction and permanent and pieces like that. And so they are, trying to figure out ways for financing. This is, most particularly in the development side of things, tools so that we can get these really important facilities built. But that when there's sort of less obvious ways of, having a long-term facility that's providing homeless services is not, may not have a huge stream of additional rental income in which to pay, in which to then pay permanent loans. So I think that's just a piece to know and understand, and really kind of try to access and resource some of the pieces. And the government, much of our government financing in Washington does come through as forms of loans. They are very long-term. Their interest rates are lower. They're much more flexible than sort of some of the traditional bank lending, but they do still come in as loans. And so it's sort of, that's the piece that's important to remember, and these sort of core principles.
Yep, sounds good. Thank you for that addition. And once a project is completed, then, as I said, the permanent loan is going to generally take out the construction loan. And that could be, as Kristen was saying as well, like it could be multiple loans that are coming in, not just like your main hard debt loan. You could have some of those soft sources that we were mentioning before. And also, of course, in affordable housing, you're going to see the equity that comes in exchange for the tax credits that's really bringing down the amount that the loan needs to be. And that's how, projects become affordable. And many lenders actually are interested in carrying both the construction and perm financing for a project. I mean, banks make money by lending money, right? So if it's a good project, they like generally to see both sides of it. But we have had projects where there was one lender on the construction side and one on the perm side. And, the downside to having multiple players in from that perspective is that you've got conflicting interests sometimes. So if a construction lender and a perm lender, it's really the same bank, they're going to work, the two areas are going to work together to make sure that everything converts. And conversion means that you're going from the period of time that's covered by the construction loan into the permanent financing with, again, the construction loan being paid off. But for some, for many lenders to get to the perm piece, the lender may require stabilized operations for a period of time. And usually that's only, 3 months or so. But this is, again, why that DCR calculation is so important to the perm lender. They want to make sure that that loan's going to be repaid. We have a property that's in Oregon that has been completed for probably 3 years, I think, at this point. And they are still underneath their construction loan. They have not been able to convert to perm. There's 2 separate lenders. The perm lender requires that stabilization. And unfortunately, it's, a permanent supportive housing project. A lot of folks weren't paying rent during COVID. They can't get them to pay rent. There's some restrictions that are keeping them from going through the eviction process. They're just really, in a bad spot now. So the construction lender has continued to extend the loan out, but this last extension that we did, which honestly seems like it was a month ago, but it was like 5 months ago. So we're really facing it again, but it required the general partner to do a pay down of the construction loan to a certain amount so that they felt more comfortable. So anyways, it's a lot of creativity, I think, sometimes that go, a lot of players at the table whenever you're trying to negotiate or renegotiate when things go awry. But generally speaking, most of the time we see that things go, very smoothly. And, we had talked about that concept of that soft debt previously, which is, you may have heard the term before, gap financing. So this is the type of financing, again, that's becomes part of that debt stack, and it's required when there's a difference between the amount of perm debt available and say the equity that comes from the investor compared to project total cost. So the development budget is really going to outline what those sources are from the very beginning. And you could get, community development block grant funds, there's affordable housing program funds and other state and local subsidies, but those funds essentially are bridging that gap between the total project costs less the perm loan and equity investments. And, from an economic standpoint, honestly, most projects, couldn't be built without those additional sources of funding. I mean, sometimes we will see, 3, 4, sometimes 5 types of financing that go into a deal. Grow America, are an equity investor in a project in Seattle called 12th Avenue Arts. I don't know if I'm sure maybe some of you have heard of that project before. So it has a parking garage that is below ground that actually is completely leased by the police department. There's no parking there for residents. It has some small commercial spaces, mostly like small types of restaurants on the first floor. Then it has like some dance studio space that can be rented. And then you have some commercial office space in there, and you have affordable housing units that are being leased above all of that. And that's what we're invested in. But to get a project like that put together, I mean, the financing stack was crazy, and there's different components. So when I say, we're an investor in the building, we're just an investor in the affordable housing space above. But one of the other programs that Grow America has is we do always look to get a new market tax credit allocation, which is a different group from the group that I work with. But we had some new market credit tax credits that went into the commercial piece. I previously mentioned that I worked at Key Bank, and this project was coming together when I worked at Key Bank, and Key actually put some dollars into it. So it was multiple, sort of equity investors, multiple types of, tax credits, new market, the light tech tax credits, and traditional permanent financing sources that went in, and some soft dollars. So sometimes it takes a village to get something really amazing like that put together, and people who are, very smart and doing these things. But, as an asset manager, we're dealing with, what comes after. So, we may not be the ones that are putting the deal together, but we really do need to understand how it's put together so that we can make sure that, everything is being addressed and reported properly and all the payments are being made. We'll go to the next slide. So I mentioned that we were going to go through, more specific example of a debt coverage ratio. I'm sure you guys already get it, talked about it quite a bit, but I just want to show you how the numbers can really skew the DCR in ways that maybe you're not thinking about. So in this example, we're going to look at which project has more margin for error. So I'm going to let you just sort of study this slide on the screen for just a minute, and then we're going to walk through it. Can you go back to that screen, please? Thank you. We're going to be on the screen for just a few minutes here. So in this example, if we look at Project A has $150,000 in revenue, and Project B has $250,000 in revenue. And again, because we try to make things very simplistic, they both have the same amount of expenses, $130,000. So in this example, Project A has an NOI, revenues minus expenses, operating expenses, of $20,000. In example B, they have an NOI of $120,000 because they have so much more in revenue. So at this point, you would stop and think, well, Project B is in a really good spot. And honestly, they both are because they have positive NOI. So we like to see that. But then we need to talk about, debt service. And fortunately, For the first project, Project A, the development team was able to put together this deal with only $10,000 in annual debt service payments being due. And it's a good thing in this example, of course, that Project B had so much NOI, because if you look at Project B, the development team actually has much more debt on this project. So their debt service is $90,000. So you start with such a high number, and thank goodness, because by the time you account for the debt service, you don't have as much cash flow as you would really think that it should. So even though at this point, as we're looking at that cash flow line, we can see Project B has more cash flow than Project A. But because of the amount of the debt service, look at the impact at the bottom there on the DCRs. So the calculation for Project A comes down to a DCR of 2.0, again, very healthy. And thankfully for Project B, still a healthy DCR of 1.33, again, above the 1.15 or the 1.2. So, looking again for, margin for error going forward, which project do you think has more margin to cover potential increases in expenses or maybe reductions in revenue for some reason? Kristen's going to come back. So in this example, I'm sure you've all figured this out. It's example B. Although example A has a much higher DCR, if expenses increase by 10,000 for the year, the DCR for Project A would drop down to 1.0. Again, that break even that we want to have, as a very baseline, but much more than that. And there really wouldn't be any excess cash flow. But the DCR for Project B, even though it's lower to start with, it would only drop down to like a 1.22, and there would still be surplus cash flow of 20,000. So while Project B has more margin for error, it also shows you that the DCR isn't always the perfect measurement of performance. It's also important to look at the operational aspects of the property. So we said that, 1.15, 1.2 is what we normally see. The higher, the better. But again, in this instance, from a cash flow perspective, Project B is a little bit better off. So what goes into a balance sheet? There's a really basic formula for a balance sheet, which is there's three components. There's assets, liabilities, and equity. And it's called a balance sheet because ultimately the total of your assets are going to equal the sum of the liabilities and equity for the partnership. The balance sheet reflects where a company gets its where a company has cash, all of the places that it has cash. So maybe it has operating cash. We talked about reserves before, and also how it uses that cash by reflecting, the changes in some of the other assets and liabilities, building the worth of the company through additional owner investments in the business, retaining the profits generated by the business. And we're going to subtract any losses generated by and assets drawn out of the business by the owners. So a little more detail. That's a lot of information. We can go to the next slide, please. There's a certain organization of the balance sheet. So just like the income statement was organized, showing revenue at the top and then showing your expenses in the bottom section, the top section of a balance sheet shows the assets, which is essentially what a business owns. So it would include current assets, which is, cash, something that's liquid. It could also show cash that's not quite as liquid if that liquidity is determined as being available in less than 12 months. But longer than that, it's going to become a long-term asset. So a long-term asset, for a simple example, could be a certificate of deposit that is going to come due in 5 years. So if the business needed those funds, they're not available on a current basis. So that is in long-term assets. It also would have this a section that's going to show you the value of the building, maybe the value of maybe there's a vehicle asset that is owned by the partnership. So whatever those tangible items are that are owned by the business, whether they're in the sense of the building or a vehicle, whether they're fully paid off or not, whatever the value of those items are is on the asset side of your balance sheet. On the right-hand side, we see the liabilities, which in the presentation would be the lower portion of the statement. So the liability section is divided into two pieces. So you have current liabilities, and it's basically items that are due in less than 12 months. So your normal operating payables are current liabilities. You could have maybe insurance premiums that are going to be due within a certain period of time that you've been accruing. As Kristen had mentioned before, like we're talking about recognizing that expense 1/12 every month. So if it hasn't been paid yet, it would be showing as a liability. And then your long-term liabilities are really liabilities that are due out more than 12 months from now. So we're going to see the longer term portion of any loans in this section. And when your CPA is performing a statement for you, putting it together at the end of the year, they're going to look at what your loan balance is. If there's a portion, whatever portion is due within the next 12 months, they're going to bring that up into your current liabilities and just show the amount that's beyond that in the lower section of long-term liabilities. And the equity section, it's going to show how much the owner has put into the project, and also an accumulation of losses, but hopefully gains from that project over a period of time. And the math works out so that you have assets equaling those liabilities and the equity. Next slide, please. And so here's a great sample. So we talked about the assets being at the top. So in this example, we have a checking account or savings account that has $86,500 in it. This is actually the balance sheet of a manufacturing company, ultimately, because they're showing raw materials, supplies. So anything that's in inventory would be included here. When you pre-purchase on a property level, say you purchase a bunch of light bulbs or furnace filters or smoke detectors or things that you want to have in stock in case something happens. Maybe you have an extra refrigerator in case something happens. You know, you could technically not expense that. You could show it as an asset, but from a practical standpoint, folks really don't do that unless it's something really significant. And in this example, this company has machinery and equipment that's worth $65,000, and this company is actually renting somewhere, so they paid out a rent deposit of $20,000 that ultimately will come back to them. It wasn't an expense, so that's why they're showing that as an asset. In the liabilities and equity section, in current liabilities, they have $7,500 in accounts payable, and they have the current portion of the long-term debt that they have for $4,600 on the books, and they still have another $70,400 of liability or loan that's going to be due sometime in the future, more than 12 months from now. So at the end of the statement, we're going to see the equity section, and the equity shows that the owner has put in $100,000. And if we look up above, we see in total assets, $182,500 in total assets, and we have $182,500 in liabilities and equity. So the balance sheet is truly balanced, and this is the presentation of a balance sheet. Next page, please. Do we have any questions up to that point? No hands? Okay, we're going to go to the next screen, and we're really going to talk now about sort of how that owner's equity section changes over time and what really happens to that profit or loss calculated number on the income statement. So on the profit and loss or the income statement, or we also hear called operating statements, they're all really synonymous. The net income or net loss is for the period covered by the profit and loss statement. So if it's year to date, you're going to see hopefully a positive number. Maybe there is $10,000 in net income for that period. Then you get to the end of September, and now maybe you're at $15,000. You get to the end of the year, and now it's a positive $20,000. So again, if it's a positive number, that's telling you that there is net income. The property or the business is operating successfully. If the number is negative, that means that there truly was some sort of a net loss. The net profit or net loss flows through that equity section of the balance sheet that we were just looking at, and it becomes a number that flows over at the end of the year. So the accounting system or the accountant is closing out the income statement. The income statement, again, is very periodic. The balance sheet sort of lives forever until the end of the investment, and everything is sold or whatever the situation might be. So they'll close out that positive number of net income or negative number if there's a loss into the retained earnings, which again is sort of a representation of the action of that property or the success of that property on the amount that the owner has put in. So say in that previous example, the owner had put in $100,000. If for 2022, there was a net income of $20,000, now it's going to show that there's $120,000 in retained earnings, meaning money that is allocated to the owner. And when you use accounting software, there's a number of programs out there. And of course, for real estate, there are things that are used that are specific to real estate. But generally, QuickBooks is just a very broad accounting system. So all of that happens automatically when you close out year end. It sort of resets everything and starts you with zero balances starting for January, waiting for January information to come in to the income statement. But the balance sheet is going to stay static other than the changes that are coming through periodically there, but it doesn't go away like the income statement does. Next slide, please. This next slide is going to show us what happened. So if we look to the right side, this is showing the income, gross profit. These are just, examples of all different kinds of businesses in here, but there might be income taxes that are paid, and whatever that final number is, you can follow the arrow over and it goes into retained earnings. So if you look above retained earnings, you see common stock, and that's what we saw in the balance sheet example where the 100,000 was. And then you're going to have, say, the 20,000 that comes over in retained earnings. And maybe the next year it's 10,000 to the plus, and maybe the next year it's minus 15. So over time, whatever that accumulation is, it's going to be recognized in that retained earnings section. And it's going to help the owner to see sort of what the equity is in that business or that building and what the net worth is at that point in time. So this is just broken down a little bit so just you can kind of see the flow of information over to from one side to the other side. Okay, next slide, please. We talked about budgeting a little bit earlier in the week, and we want to talk about a little bit more detail here. I'm sure you've all been involved in budgeting at some time, but you're starting with your revenue forecast. So you want to make sure if it's commercial building that you are making sure that you understand what the rental increases are. A lot of those leases, as we talked about before, may have renewal periods of 3 to 5 years. So you want to make sure that you're not just looking at the rent that particular resident or tenant paid the year before, but what is expected for the next year. So you're calculating a good number. When it comes to residential, again, you are thinking about what are the increases I can put into place for next year. And maybe it's flat. Hopefully it's not flat, because your expenses, I can guarantee you, are always going to go up. One thing that you need to make sure of is that you don't miss a rental increase when you can put one into place, because you really, over time, never catch up from missing an increase. But again, there are periods of time where it just doesn't happen because of the economy, competition, whatever it might be. And certainly with projects that have restrictions on their rents, there is definitely a schedule you've got to look at and figure out, what is practical for the next year. Or if you have, say, HUD dollars and have a HUD contract for subsidy on the rent, the contractor is going to tell you what the increases are going to be. It's not something you're pulling out. It's going to be told to you. So you just make sure that you've accounted for all of those things. So you want to also complete, your forecast of units that are necessary in order to support whatever services that you're going to be providing to the property. How many residents are going to be utilizing those services? How much are we going to be able to get maybe from grant income to cover those? We've talked about that before. And maybe it's across the board. Maybe it's every single unit is going to need services, and we need to make sure that we've got the right amount of support coming in, whether that's grant income or just someone coming on the property to provide that service for you at no cost. Calculating the expenses. So we have some sort of general accounting terms included in here. So we're talking about inventory. We don't really see much of that, of course, in a residential or commercial, because as I said before, unless it's some big inventory item, usually those are just expense. They're not part of your budget going forward. You've already got them. You're not allocating them in any different way. And cost of goods sold is, again, of course, something related to sort of an industry type of term. There could be labor, other costs directly related if it's a service kind of business. But for properties expenses, you want to make sure that you understand, are there going to be significant real estate increases, real estate tax increases, because maybe a levy has passed now. So you want to make sure you're on top of that. In some municipalities, we've seen over the last 5 to 10 years where the sewer system is aging, and the municipalities have put in very significant increases to water and sewer expenses so that they have the dollars to repair some of those lines. If that's the situation, you need to know if you're getting a 50% increase in water and sewer cost over the next few years, you need to be able to budget that in. So just being in tune with what's going on in your area is very important. You don't want to have a miss. And again, you don't want to assume anything. You don't want to assume, oh, I'll just escalate the cost of water and sewer by 3%, and oh, here's my budget, and my budget shows me that I can put in that carpeting I've wanted in that common area that we talked about before, when in reality, you buy that in January, you don't want to find out in April that those costs have gone up significantly. Like you should have known. You should have been able to make a call, go online, figure that out. You should know that. So again, our budget is going to be an annual schedule by month. We're going to show revenue, and we're going to show all of our expenses, including our admin expenses and direct operating expenses. Next slide, please. Ignore that, we did that. All right, so here we are with just a very, again, basic kind of budget. When you're budgeting, just as I was talking about with the income statement, how there's a very detailed income statement and then a summarized statement, you really want to do the same thing when you're budgeting. You start with your very detailed statement so you can really drill down on each expense line item. And you shouldn't have 100 line items. Maybe you shouldn't even have 50, but there's just some very obvious line items that you should have. This budget comparison here, or not comparison, but format, is showing something, again, for maybe an industry, just to give you a little different perspective, but the process is actually the same. So you're seeing, a month, this for each month of the year, you're seeing a total at the end. Ideally, as I mentioned before, you would really want to put your prior year's actuals, and you can calculate sort of, like, say you're doing this, October 1st. So what are your numbers through the end of September? So that would represent 75%. Try to project out what the remaining expenses are for the current year, just so you have other things to sort of guide you as a good place, a good starting place. Once you get the income pinned down, spend a good amount of time with that. Be very thorough. Make sure that, again, that you understand if there are increases that you can ask for or available to you. You're going to have, instead of cost of goods sold, you're just going to have your operating expenses. So again, you're going to see maintenance, you're going to see insurance, you're going to see real estate taxes, you're going to see, the cost of the folks that are working at your property. And we've seen, pretty good increases to those labor numbers over the last few years. There's been a lot of difficulty. I'm sure you guys have experienced this as well, and trying to retain, especially good staff at properties. And when there are vacant positions, it's been very challenging to try to get folks, into those positions. Sometimes, bonuses have had to be, offered in certain areas to get that to happen. And just, you kind of go down the list, just make sure you're accounting for everything, look this over, talk to the property manager. Again, this is not, as we said before, an experience that you go through on your own. You're setting the pace for it, you're setting the tone for it, the expectations, but you need others involved in this as well. And ultimately, probably a summarized version is what an owner is going to want to look at. But if they have questions about a particular category, you've got that detailed version that you can pull up and have a good discussion with. And if you are working with a nonprofit, again, you might have the board that has to review and approve the budget before you can move forward. And, you know, at the end of it, who needs to have a copy of this budget? If you have investors, they may need to see a copy. If your project, maybe if your project hasn't been performing well, your lender might want to see a copy. Generally, they don't. But if they're trying to keep closer tabs on you, they may ask for that just so that they can see what can be expected going forward. And then you have your debt expense toward the bottom. And if you have reserves, make sure you put those into your budget so that you're not forgetting about those. This is also a great time to think about what capital needs that you have. We're going to talk about this on the next slide. If we could go to that next slide, please. So from a capital expense perspective, you know, you're trying to anticipate those needs of the property in advance. And we talked about, you know, if you have a lot of things going on at the property, a lot of things you're concerned about, maybe you want to get a third party to do a capital needs assessment for you. But, you know, generally you're not at that point, you know, especially pretty early on in any deal. But, you know, how old is your roof? How old are the windows? How is the HVAC performing? You know, you're looking back to your, you know, income statement for the current year and realizing, if you hadn't already, that you spent a lot of money maintaining this HVAC system. You're digging into it. You're finding out that really there's a recommendation for it to be, you know, actually replaced at some point. Can you do it this year? You don't know, but included on your list, that ongoing list I talked about throughout the year of things that you know that you want to get done. What are the wants versus the needs? The needs need to be taken care of first. And again, I relate this back to our own personal lives. Like there's a lot of things we would like to do. You know, we'd like to take vacations. We'd like to put a new patio in, whatever it might be. So what are needs, what are wants, and how is this going to fit into your budget? Ultimately, it needs to fit into the budget. And be, as I said, be realistic about that useful life of things. I think appliances are just the craziest part, just because if you're starting out with a new building or you're recently rehabbed the building and say you replaced or installed all new appliances, if everything is petering out at the end of 7 years, that's a tremendous expense that's going to hit you pretty much all at one time. And I think, you know, folks have in the past thought, oh, well, I will just budget down the road for 5 refrigerator replacements, 5 stove replacements each year for so many years. But the way that things are breaking down these days, you really have to think about, you know, planning for that in advance, making sure you're funding the reserves, and don't try to hit the reserves for little nickel and dime stuff because you know that you're going to need this big number somewhere in the future. But is that year this year? If so, let's get this into your budget, into the capital section. Just have a separate section and list out toward the bottom all of the items, because the building owner is definitely going to want to talk to you about those capital items. And they may have some items of their own that they want to get taken care of. You may think this is the most important thing. They may have a differing opinion. Ultimately, they're the owner, but you need to be able to really respectfully kind of explain how you're feeling about something. And when I say feeling, it's not like emotional feelings, but feelings for the building. So, you know, you've looked in the marketplace, there's all of this new competition. They have like amazing equipment in their exercise room. We have one treadmill and a set of hand weights. Like we're just not competitive. So the owner may think, oh, I need a better sign outside. And maybe you do. But, you know, from a practical living perspective, that what the residents really want is an updated workout room. And how do you find that out? Because you're paying attention. You're asking the property manager, how often is this room used? You're having community meetings. What is it that you guys are looking for? You know, what would be important to you? And you're bringing that back to the owner when you're talking about the budget and saying, these are the things I want to budget for this year. This is something that has to be done for the wellness of the building. And here are some things that are really important to the residents that we're not able to offer. And I'm concerned about us losing some of our occupancy to the competition coming down the road. So you're thinking about that holistic picture of it. If there's a failing component, we talked before about the importance of understanding what are these warranties, because the most painful thing is to just react and pay for something only to find out later it probably should have been under the warranty. That's money that's gone. Good luck trying to get that back. It just doesn't really happen. The other thing we've had some success with It was a building we had in Chicago that had a roof that was failing. And it really was out of the warranty period. I confirmed that. But we thought the best place to start in terms of, getting the roof replaced and figuring out, confirming, I guess, does it need to be replaced, or do we still just keep patching it? Is we went back to the original contractor, who went back to the original subcontractor, and that subcontractor came out and took a look at it. And even though it was out of warranty, they determined that there was a failure due to something that they did wrong. Like, the chances of a subcontractor stepping up and admitting to something is few and far between. But if we would have just assumed, okay, it's out of warranty, let's get some bids from a couple people and get this done, we wouldn't have had that unique opportunity to have the roof completely replaced at no cost to the building. And it was a building that was struggling a little bit financially. So it really was just, such a wonderful windfall, honestly. And I guess it comes back to this idea too of, if you don't ask, the answer is always no. So just push. Even if you see that the warranty has expired, just look at your documentation, see if you can build a case that maybe there's something bigger going on here. And don't be afraid of reaching out and trying to see if you can get, even if it's a discount, but see if you can get some sort of a deal for that particular item. And those lease versus buy versus financing decisions. So think about a car, because obviously sometimes we have, shuttles and such for buildings, but based upon where you are financially, does it make sense to lease? Are there good lease rates on that cargo vehicle, or should we just buy it? Is there a good deal? Is there a rebate? Should we finance it? Look at all your options. Don't just make one assumption. Look at all the options and have those options available for discussion. And the capital needs assessment, again, we talked about that before, but that also can back up, to the owner, your perspective on certain things that need to be done. But at the end of the day, whatever you're planning on doing for that year, you have to have the money to do it. And maybe there isn't money in reserves, but maybe it's something important enough that the owner is willing to put the money into the project, so that you can get that taken care of before you have, a bigger problem down the road. So any questions on budgeting? It's so fun. I know you guys are, like I said, probably already working on it, but we're going to switch over now if there are no questions, and we're going to have Katisha come back on. Katisha, thanks for coming onto the webinar again. We'll go to the next slide.
And Carolyn, I'm just going to interrupt really briefly. As I noted at the beginning, unfortunately, I need to step away for the balance for a meeting that I have. And so I, again, thank you all for spending the time with us. Really appreciate your interest in the topic and willingness to listen to us talk. And I hope you found it informative. And do not hesitate. I mean, really have an open. I care deeply about supporting folks in this sort of journey around real estate and making sure that you and your organizations can be successful. So please do not hesitate to reach out. Oh, my best.
Thanks so much, Kristen. We
Take
appreciate
care.
your participation.
Thanks,
Okay, thank you.
Kristen.
Take care.
Well, thanks, Carolyn, for you and Kristen's presentation today. Thanks for everyone who has returned for the last day 3 of this asset management course. I mean, I honestly love returning each year. This is my 2nd year, and being able to work with Carolyn and Kristen to help share the information and knowledge that we have with you all to support everyone's endeavors, careers, continuing education. And so for those who know me, I kind of just like to talk candidly about the real world experiences that, I've gone through in asset and property management, and, what I'm currently working on and things like that. So I like to talk very candidly about that. And so I hope that's, continues to be okay for everyone. But one of the topics I have been assigned is the topic of trouble in paradise, which is just crisis management, I like to think. And so depending on where on the spectrum that crisis lies, we can talk about as we go through these subtopics, but problem solving is definitely a theme in asset and property management that you always have to be thinking about. And if you have been able to develop really strong problem solving skills, they will lend well to this type of work, particularly when you are responding to building issues, tenant issues, simultaneously while stewarding your asset through changes, external changes that you may not always have control over. So being able to operate within that space is really going to be important in your work. And so to just kind of keep on schedule as best as I can, because there's just, always so much information to share. We have a short period of time. I'll just kind of go through the points and, just share ideas and knowledge on each point. So what you want to do as it pertains to these points going down, as far as we'll just address one by one. So declining occupancy. So what this means is just paying attention to your vacancy rates. Your vacancy rates are indications of how your building or your asset may very well be performing. So we host like monthly meetings to kind of review our assets under our management, and particularly if you're stewarding or managing a multifamily property with several units, rental units. This is going to be something that you pay attention to a lot, where your units are, vacant month over month. You want to have a goal for, turning over each unit as they become vacant, so you can then be in a position to release them as quickly as possible. But if you are, noticing in your reports, over time that your occupancy continues to decline each month, then it could be indicative of a larger issue. And it kind of takes some problem solving and some investigation to really kind of drill down into why that might occur. There is a kind of a typical or rule of thumb, depending on the type of asset and how big it is and how many units you have, of what might be deemed a healthy vacancy rate. And then over and above that percentage, you want to definitely identify that and be concerned and put some attention to your vacancy rate. And so that rate is also driven by market, what's kind of standard in the market for multifamily housing, or, whatever other type of asset you're managing. But I like to think and I say standard in terms of the multifamily market, if you're managing a unit or building that's anywhere between 50 and 75 units up to 200 units, you want to be around 5%, is pretty standard. And Carolyn, feel free to correct me. But these are just kind of what I've seen. But a 5% vacancy rate is pretty standard and typical in multifamily in the Seattle market, at least.
Yes, it is very typical. And when we're like doing a pro forma for a new project and sort of analyzing, we always do a pro forma at 7%, just sort of a worst case scenario. But in reality, 5% is a very good rule of thumb. We're just trying to put an extra buffer in when we're sort of looking at these new deals. And, we have properties that have, 1%, 2%. Before you came back to join us, I was talking about, during COVID and some of our assisted living projects that, families didn't want to move their loved ones in because they wouldn't be able to see them then for an extended period of time. So we saw some incredible vacancies, but again, thankfully those properties had, really positive DCRs and good cash flow, and they could really, withstand that, on the short term. So it wasn't a problem. But yeah, I think if you budget 5%, think about 5%. That's good. If you see something higher than that, you definitely have to get in there. Or, if you see that it's trending, I think that's the other piece. If things are going in a bad way, then you need to really jump in.
Yeah, for sure. And I think right now in the Seattle market, there's been some some trending in terms of declining occupancy, and it could be for a variety of reasons. If you're experiencing turnover, maybe wondering why you're experiencing turnover in the building. It could be a myriad of things. It could be maybe where your asset lies in terms of its competitive position to other buildings. People might be finding better deals elsewhere. It could be, anything from safety issues in the building. Maybe some things have occurred in the building, maybe break-ins, unlawful access, problem tenants or neighbors. People aren't feeling safe. They could be providing notices to vacate and move. Maybe your units aren't releasing as quickly as they can. It could be a turnover issue. Are the maintenance and facilities department turning the units over quickly so they could be released quickly? Is it a leasing issue? Are we getting people through that pipeline to release those units in the building at a particular pace and standard? So you really want to pay attention to that because one, you want to maintain a healthy vacancy rate, and then also you want to make sure that you are capturing the revenues that those units generate. And so to the next point in 1B, declining revenue are correlated with declining occupancy. And so if you aren't maintaining your occupancy standards within the building, then that also means that you are not collecting or earning revenue as you can. So it's a direct correlation. And if you are not earning the intended revenue in a building, then that also affects your budget and what you're able to project. And so both of those things are closely related. You want to keep an eye on it and understand that your occupancy in a building directly correlates to the revenue that the asset is generating. Point 1C, increased concessions. That's another kind of indicator on maybe looking at your asset and seeing how it's performing or not performing. If you are noticing that the staff or the property management or leasing agent is offering more concessions than maybe would be normal or typical, why does the asset have to incentivize over what's maybe normal in industry to be attractive to potential renters? That's a question. Again, I kind of like to look at competitive standing of your asset as it compares to others. It could be indicative of just the market. Are we in a market where people have more options? Looking at the labor market and employment and salaries and benefits, and cost of living, all these external things could affect or have an effect on your offering in terms of what your asset is providing to the market and if people are attracted to it. And so these are indicators that might lead to a more underlining problem. And so you definitely want to keep an eye on them for sure. Point 1D, increased expenses. This is another major one. I say, just like declining revenue, if your expenses in the building are increasing, then it directly affects your budget, your projections, why are the expenses increasing? I always say, have a why ask question, curiosity detective type mentality in asset and property management, because when you get down to the root of things, then you can, they could then answer other questions. So for example, you are noticing that your materials for your maintenance costs are increasing. Why are we needing more materials? Is our maintenance staff well equipped and have the tools necessary to do the job that they're responsible for doing? Are we providing them the support that they need? Or are we, when we turn the units, the cosmetic repairs being stewarded properly? Are we noticing that there are more repairs needed in terms of plumbing or electrical? Where are the increased expenses coming from? Expenses are definitely something you want to pay attention to and be able to manage well, and not have situations to where they're increasing, because again, it could affect your budget. So just pay attention to these things. I like to look at the monthly reports to see the variance month by month, and then look at things quarterly and annually, and to understand the trend. Expenses could be like a one-time, one-off. Maybe there was more significant damage in one particular unit than a normal turnover would be. And so if it's a one-time thing, that's something to take into account for. But if you're noticing a trend, that's something really indicative of a larger issue. You want to kind of get down to the root of it. Point 1E, reserves not properly funded. This is a big one. I'm sure Caroline talked a lot about this in terms of having an adequate reserve account, because, a reserve account, I look at it like a savings account. And when you have like an unforeseen building repair, I think I talked on day 2 and maybe even on day 1 about an issue we had in one of our industrial assets that we manage. There was a building flood in the basement, and just positioning the owner to have funds available to respond to those type of unforeseen issues. If it's not properly funded, then you don't want to be in a position where you have an extraordinary situation happen and you just have no way to financially respond to it. It's just not a good place to position your owner in. And so doing the proper planning up front and for funding these reserve accounts to be able to respond to these unforeseen issues or problems that come up is definitely a strategy you want to take into account as an asset manager. And then point 1F, high staff turnover. That's a major indication that something is wrong. Just in my experience, I've worked for different organizations, and the organizations that I have observed and witnessed there being high staff turnover issues tend to be problematic in terms of being able to, what I consider, effectively manage their assets. Because when you have high staff turnover, you're not only dealing with costs and expenses related to retraining and rehiring new people. You're dealing with the loss of intellectual knowledge, historical knowledge, and context related to the person who no longer works for the organization, and being able to recapture that or retrain, relearn that into the new staff. If you are, lose your maintenance staff or your facility staff, especially a good one, these are all things that are red flags, and you want to ask yourself, okay, what is the issue? Is the workload for the staff, maybe becoming unmanageable? Are they getting the support that they need from you as the asset manager? What is the culture and environment in the organization, and even within the community that the asset provides, if they live on site and interact with the community on a day-to-day basis? Is it a healthy environment? Do people want to come to work and want to do this job? Are they in a safe space? All these things are just first come, first mind things that could happen in terms of understanding and being able to identify what could possibly be the problem in your situation. But definitely high staff turnover is an issue. It's just not good in terms of being able to effectively manage your asset, because you want to make sure that not only does the staff have what they need, but also understand that they are stewarding the asset and the community and the people that live in the building. And so, when there's a loss of staff, your residents may not know who to talk to, who to go to. They've built relationships with that staff over time, and just having a high staff turnover is just never a good thing for any property or asset management organization as it pertains to being able to steward the asset for the owner. Next slide, please. Okay, so oh yes, you're a property detective. Yes. I think this is, what I alluded to, ask questions, be inquisitive, trying to figure out what is going on. So I like to think of myself, and I've been told that I'm someone called me one time. What did she say? She said, you overanalyze things. And for a long time in my early career, I might have looked at that as a bad thing, but over time I realized no, that's actually a good thing. Because when you could overanalyze or at least analyze what might be going on in the property or just in the day-to-day operation and management of it, you will be able to identify things that aren't maybe surface as it pertains to the property. So it's a good thing. If you have been called someone like an overthinker or you're over analytical, that's a good thing. Don't take it how I took it at the beginning of my career and thought of it as a negative. It's actually a positive and a skill set that will help and support you in being able to effectively manage your asset properly. Again, you work for the owner and the owner trusts that you will be able to see the things that may not readily be able to be seen from the kind of surface level standpoint. So just, look, it's a good thing. What you can see from your inside your office. Yes, there's different perspectives in terms of the information that you might be privy to. For me, in my property management early days, I spent a lot of time out in the field, talking to the tenants, touring the properties. Just I spent more time outside than in my office, me personally. And what that did was that it just gave me the perspective that you just don't have when you're in the office. You can't see what you need to see all the time when you're in front of your computer. You can see the numbers, sure, but again, when you spend time viewing the property, touring the property, you can put eyes on things and it can fill in the color to the story that you're trying to put together to be able to assess a property and or a situation. So yeah, be a detective, ask questions. People might think you're annoying, but that's okay. Your job is to make sure that the asset is effectively managed and stored. Compare financial operating results to underwriting projections and annual budgets. Yeah, so Caroline, you could probably chime in on this one if you feel the need to, but it's always a good thing, and I think it's just standard when you prepare your budgets and your projections. You want One of the things someone told me earlier in my budgeting career was always look at the variance. Okay, we plan and we prep the budget and projections, but what are we actually doing and how are we actually operating in accordance to that budget and projection? And so again, like if you have one-offs that drives your budget expense up for a month, you want to know what that is and why that occurred. And if it's something that you need to take into consideration, for example, if you have a leak that occurs in one month and you have, some damage to a unit or what have you, sure, you had a leak, but is this leak something that just happened as a one-time thing, or is it indicative of a larger plumbing issue that may need to be addressed? And so again, having eyes on the property, but then also utilizing that same analysis and using those same evaluation skills and techniques as you compare your financial statements is definitely a skill set you want to have in asset property management. Point 2D, internal watch list versus external watch list. Let's see. I think this point relates to just understanding and knowing the things that are privy internally to the organization and asset, and then those external factors that we can't always project. So for example, internally we have our rent roll and we could look at our rent collection and our expenses related to the budget and all those types of things. Those are the things that we are privy to internally. Externally, say for example, there is a new building that is similar to yours that is being built 2 blocks away. No, that changes your competitive standing in terms of your offering to the public. And so that might be something you take into consideration in terms of budgeting or doing your projections for, vacancy rate. There might be some chance that you will receive some notice of terminations on your lease because you have now increased external pressure from your competitors. Or, for example, if we experienced I don't think any of us foresaw the pandemic coming, and how that had a huge effect on renters and their work stability, and being able to hold their jobs, or maybe choosing to be on employment, whether it's voluntarily or involuntarily. And then landlord tenant laws changing and the eviction process. Those are all things that some things people foresaw coming, and then some things that they did not foresee coming in terms of external forces. So being able to, and I think this is more kind of an asset management thing too, understand what's going on within the organization and within your property portfolio, but then also having an eye and ear to the external market. Did I cover that point, Carolyn, correctly?
Yes, no, I think you did a great job. And I had an interesting story. I think it's interesting anyhow about sort of this watch list concept. So we have, going back to the DCR, we have that as being sort of our major component of determining if a project that we've invested in is going to be on the watch list. So we have this assisted living project that is on a campus in East Cleveland. And the overall organization is a foundation that is incredibly wealthy. It started with a grant from a member of the Rockefeller family back in the day, because the Rockefellers, lived in Cleveland. But anyhow, that's a side note. So the project, it is the part that we're involved in is the assisted living part. And they have never fully leased up that building. And it's been 5 years now. And it is a beautiful building. And it's serving a really wonderful purpose. But unfortunately for us, it was on the watch list because of the lower occupancy meant that there's lower revenue, and financially it just looked like it wasn't performing well. And so the owner's perspective was we don't care if we're on your watch list, because they know that they have this huge endowment. There's never any issue. It's on their campus. It's part of their continuum of care plan. They just really had a hard time understanding. And this is the first time they had an investor in one of their projects. So it was a learning experience for them too. So we really had to sit down and just sort of go through what it means from our perspective and theirs if they're on our watch list, right? And so just a couple quick highlights is we go from collecting quarterly financials and talking to them, every quarter, so 4 times a year, to a schedule where they're going to report to us every month, and they're going to hear from us every month, and it takes more staff time and da-da. So it's at the end of the conversation, I think that, they really did understand then why it mattered to us, and it started to matter to them. And I said, you don't have to actually move the cash over, but if you would at least, book that you're providing a subsidy to the project, whether it's paid or unpaid. So I'm kind of harking back now to when we were talking about a cash flow statement versus an accrual statement. So in this instant, if they're not actually moving the cash over and we had a cash statement, the property would still be looking like it wasn't performing well. But bringing that in under an accrual basis and showing that is as a liability really from the owner to put that in if it's needed, but book it so that they're having positive financial operations, then they were able to move off the watch list and everything calms down and everything is fine again. But sometimes, again, communication, which we've talked about throughout this series, of course, is so important. And that watch list, just really communicating with folks. And the one place that we would like to get to, but from a staffing perspective, have never been able to reach it yet, but is always a goal for me every year, is to not just have that extra attention on properties that are on our watch list, but to really look at the properties that are sort of marginal. And so if anything, I would encourage you guys to look at your properties, even if they are not on someone's watch list, if they're getting closer or trending closer, really spend a little bit more time on those properties, maybe put them on your internal watch list so they're getting more attention. And as we know, there's just never enough time to do absolutely everything we want. But see if there's anything that you can jump in and do to turn things around a little bit. Maybe look at reducing expenses. And I know that Katisha is going to talk about some remedies in a session here, but just go ahead and just see if you can do anything to sort of bring expenses down or increase revenue to keep it from going full on your watch list and or the watch list of your external partners. Want to move to the next slide, Katisha?
Next slide, yes.
Okay.
Remedies. So we talked, I mean, a little bit about, problems. I hate to say, in my experience, there's so many things that could be classified under problem solving. Again, in the interest of time, we don't have time to cover even a fraction of that. But I think just communicating the message that you really want to be as proactive in terms of problem solving as possible as you can, with the understanding that you're not going to be able to foresee everything. But in terms of the remedies of counteracting some of the problems that you will have or encounter in terms of effectively managing your asset, the remedies are still kind of the same and similar. Increase your revenue. This is pertaining to a lot of times related to your vacancy rate and being able to look at both your vacancy as well as your rent that you are asking for your units. And asking yourself, is there an opportunity to increase your revenue relative to the rent that are collected. And so some things that you want to just pay attention to is that, one, understanding your competitive standing will inform how you are pricing your units, and understanding where you are competitively in the market as it pertains to what you're pricing your units at, and where your price points are in line with the market. And so if there's an opportunity to increase your rental rate, take advantage of it. Again, here in Seattle, for the folks who work in the affordable housing sector, most of the assets here are income restricted in terms of qualification and management. And so the income restrictions and rental rates are set by HUD here, fostered through King County as well as the city of Seattle. And so, that's helpful, to know that you can only rent out a certain unit for a certain amount of rent. But if you are not renting it out for that allowable rent, then you may want to consider doing a rent increase for those units. Reduce expenses. Again, raise revenue, reduce expenses is kind of the main thing. Looking at your expenses and how they've been tracking and performing over the course of X amount of time. Is there a way that you can reduce operational costs and expenses related to the building? Is there a way that your maintenance and facilities department can reduce the amount of repairs that need to be made in the building over time? Can we take some proactive approaches to reducing your repair expense? For example, it could be something as, if you experience a lot of leaks in the building, if you have tenants who may not understand how to maybe they're not turning off the sink or putting the shower curtain inside the tub and letting the water spill out over. It could just be an educational and training thing. Again, it may look one way on your financials, but when you get to the root of the issue, you can think more proactively about how you can reduce some of the costs related to expenses in the building. Refinance. If you're building, your debt service that you owe on the building, or your mortgage is X amount of dollars. If the market has some attractive interest rates, you might want to think about it being an opportunity to refinance the building and to a lower rate, and subsequently being able to pay a lower mortgage if possible. These are all solutions to being able to increase the revenue in the building and reduce the expenses. Maybe you have like subcontractor contracts that are coming up for renewal with your security, your janitorial, or whatever, your HVAC, if there is an opportunity to renegotiate some of those service contracts and get a better rate, if the market is allows you to maybe explore some other options. If you are able to, obtain a quote from a different service contract provider, you may want to go to your existing one and say, hey, we got this bid for this contract. We really like your work, but they are a more affordable rate. Is there an opportunity to, participate in a renegotiation? So I think here in terms of problem solving, again, it starts off with being able to identify what the problem is, and then thinking through, these main strategies for remedying the problem on how you can address those items. Next slide.
Absolutely.
I think that might be it
No.
for, yeah.
Yeah. So we're
Problems.
going into the case study. Katisha, we're going to just all stay in like a main room. We're not going to do a breakout just to get through these today. We're going to do it all together here.
Okay.
So we have two well, it's the same property, but we have two case studies here. We have two problems, I guess I should say. So we're going to start, I'm going to read this through. So we're not going to go into the small groups as you see in number one, but we are going to take a few minutes for you guys to look at the financial that's going to be put up next. So problem A, you've been hired as the new asset manager for the Valley Apartments. It's nearing the end of the fiscal year, and you must review the profit and loss statement to determine the financial health of the organization and to see if any cost estimates will need to be updated in next year's budget. As you examine the documents, you notice that something doesn't look right. So we're going to bring up the slide if you would. So I'm going to have you take a few minutes to just, analyze this spreadsheet. See what you come up with, and then we're going to talk about it as a group. So it's about 2:40 now, maybe 2:43, something like that. I'll jump back in and we'll start, talking this through together. So just take a few minutes. I'll ask everyone to come off mute if you don't mind, so we can, talk together, collaborate about this. But, just jump in here. What are some of the things that popped out to you when you were looking at this? Any thoughts?
Something happened in the month of May with
Yeah,
maintenance.
the month of May was
Crazy happened.
very big stuff.
Maintenance and salaries.
So there was maintenance and salaries both in the
Yeah.
in the month of May that went absorbent.
Absolutely. So if we look at May, that maintenance line item, row 62, we see that 17,500, and we drop our eye to the bottom, you're right, because we see net income is actually, negative for that month. That definitely sticks out. And, if we think about May, it wasn't landscaping because that's a separate line item above. But, we definitely would want to dig into that and see what's going on. Were there more unit turns? Are there some other things that you guys could think about that or think of that would be something that would be impactful to the maintenance line item? And again, there's no right or wrong. These are just sharing of ideas.
It could be the outsource of HVAC work. It's not on the HVAC maintenance line. There's a maintenance line there, but it could have been because it's getting warmer.
Mm-hmm.
You needed those things.
But the interesting thing about that, though, is that it went back down in June and July. So
it seems like it was consistent for the rest of the year.
Yeah, something happened that 1 month.
So when you put your looking glass on here, you're definitely going to want to, investigate and see what that real, cause is. Let's look at like the water and sewer line and tell me if you have some thoughts about that. That's row 71.
Mm-hmm. Yeah, because that went up in May also.
Exactly. Do you have thoughts about what could have caused that?
Well, I'm thinking maybe there was a leak or something that happened in the sewer line.
Yeah, I think that's what I would presume as well, especially when you see that in the months after that the bill looks like it went down, to about the same amount as it was prior. But you could kind of see it building, can't you, up to that particular month
Right.
of May. So that would be a good thought. And unfortunately, as was mentioned before, you know, these like plumbing leaks can really wreak havoc on a project. And unfortunately, there's usually a lag just because, you know, you don't normally get a monthly bill per se. So when you get a quarterly bill, sometimes that horses out of the gate for a while before you can see that number and really start, you know, digging into it. And that example that Kristen gave earlier about that sort of that leak that was within the wall that was going out a drainage line. Thank goodness it did go out the drain line, because I can't even imagine the kind of damage that there would have been internally for something like that if it didn't have that outlet, for sure. And I guess the other thing, let's see, line 78, insurance. Oh, Don, feel free to unmute yourself if you'd like to, but you were saying May might have had an environmental or tenant variable like flooding, you know, a toilet or a bathtub or something, which all could be true. But if you look at line 78, that's highlighted there, you know, what are some of your thoughts there when you look at those numbers?
It looks like there was a big jump in July.
There was, yes.
And then again in October.
Exactly. And it also looks like, you know, there was sort of a monthly amount, and then all of a sudden, like you said, you see these bigger numbers and you see some zeros. And, you know, what do you think might have happened there? Just as, again, we're just guessing here, but what were some of your thoughts there? What would you be thinking if you saw that?
Maybe theft, where you had to claim something on your insurance, or damages in your insurance policy or something.
Yeah, maybe you had a deductible that you needed to cover and that was plugged in there. Maybe something happened twice. You know, maybe there was a monthly insurance premium to start out, like you could pay each month, and then the carrier wanted to have periodic payments, which again, if this was on an accrual statement, that would wash this out, right? Because you would take the 35,000, and those would be evened out a little bit, even if those come out to be higher monthly numbers, at least that would happen. And I think, you know, I'm sure you guys have some experience with insurance. Like, insurance is just the craziest expense. It's just like this crazy monster that we just can't seem to get our arms around these days. What are you guys experiencing with insurance? You seeing a lot of high increases?
Yeah.
It's you know, we've done a lot of research on this. We talk about it, you know, quite often, and unfortunately, you know, I'm not sure when we're going to get out of the cycle, I guess is the bottom line. I'm actually going to a housing conference right after Thanksgiving. There's multiple sessions, I should say, that are devoted to this topic, but I was at the CHAM conference in June, and this was definitely a hot topic for people to talk about. I mean, everyone is feeling the pain. And I think if anything, it was comforting to know that, you know, you're not alone, that everybody's going through this and trying to figure it out. But if these premiums don't start stabilizing, you know, we're really headed to a bad place, because you've got to have the insurance in place, and other things at the property are definitely going to start to suffer as time goes on. And we had also a comment from Don about liability and free compensations for whatever volume increases due to the damages in May. That could be an example as well. You know, again, it's just something for you to take a look at. And I think from a budgeting perspective, you know, if you can get a 25% increase, you know, for next year, like, that's a good number. And maybe you already know that, but as painful as it is, as you're budgeting and reviewing budgets, just keep that in mind, that it's just getting, you know, really out of hand. And, you know, I was hoping with sort of, you know, rates of return that insurance companies can get when they invest the premium dollars, that would really help start to taper things off. Because, as you know, just a few years ago, you know, you get nothing on savings. Now they can, you know, get above 5%, but it just is a crazy kind of time right now. No advice for you other than, if you are approached to consider going into an insurance captive or an insurance collaborative, just make sure that you understand what that means. There's some good ones out there and there are some that aren't good. And I'll just give you very, very brief on that. You essentially are joining a group that is it's like a risk sharing group. And there's always like a normal carrier, say Philadelphia Insurance, just as an example, behind that has an insurance policy, but the first X dollars of any claim are paid for by the group that you've just joined. So say that's $1 million. So we were approached by one of our partners who wanted to change to a specific collaborative a number of years ago. And, the broker recommended it and they had faith in the broker and they were going to receive like a 50% reduction in premium. So it's like anything else. Like you have to ask yourself, why is it that I could save 50% on my insurance? And they really didn't understand how this collaborative would work. And I had not heard that topic or that name before, did a lot of research and, asked for financials from the collaborative, because if they're paying the first $1 million on a claim, you need to make sure that they have the financial wherewithal to do that. And they were only capitalized with $5 million. So that means that they could only afford to pay 5 claims, catastrophic claims, but they had hundreds and hundreds of folks that were part of this collaborative. So that's a very high risk situation, even with good insurance behind that, but you have to be able to get through that first piece. So again, if you're just offered any kind of a deal on insurance, just really be careful, make sure that you know what you're getting into. Okay, well, we're going to talk about sort of like the next case study. We have another spreadsheet that's going to come up. I'm sorry, first I should only read the problem. So we need to go to problem B and then we'll get the spreadsheet out. So you've recently been hired as an asset manager for Valley Apartments. Sounds like a job you already had. And are trying to get a sense of the state of operations this past year by looking at the profit and loss statement from the previous year. So we're going to, as a large group, I'm going to have you study this for a couple seconds, and then we will look at a new cash flow problem and try to come up with some ideas for what might be causing it. And if we have time, which I think we might have a little bit of time, maybe there's some questions that you want to think about to ask the staff or the residents to just learn more information. And obviously we're not going to have to select a spokesperson because we're all together. Okay, so I'd like you to like really focus in, like I said, on this net rent income line. Actually, I would just go to total revenue. Go to line 33. Thank you, Nicole. Take a look across there. Like, what are you seeing and what are you thinking?
In October, there is a great reduction in total revenue, a great loss. And I'm also looking at the vacancies, which has a deficit of 6,000 too.
Yes, yes. And if we look at line 9, am I on the right line? Line 10.
Gross potential.
Vacancies. Let's look at vacancies. So if we look, the year-to-date budget, we thought it was going to be 125,000 for the year. And in reality, it was, over 200,000. So, by having the budget variance on the spreadsheet, I think it helps us really to drill in and look at that. Barbara, I'm sorry. Thank you for joining. We enjoyed having you. But, you can sort of look at that column P too, to give you a place to look at and see, something is not right with vacancies. So certainly, it raises some questions about what needs to happen. And I would say, the same thing with bad debt, right? We're seeing a pretty large variance when you think that the budget was only 20 and you're at almost 36 for the year. That is a pretty significant difference there. So I think, at the beginning of the year, let's look there. So we're already seeing beginning of the year vacancies. So I think from an asset management perspective, what I would have liked to have seen, and maybe it did happen because we don't really know the underlying, but, did somebody really jump in at the beginning to figure out why that number was so high? Thanks, Brian. Thanks for joining. I know it's very hard. We just have a couple more minutes. I know people have things to do. So I guess my question is like, why did it take so long, I think, to make some sort of a plan when we can see by looking at the numbers that from the revenue perspective, there was an issue starting at the beginning of the year. And then we see all this bad debt. It almost looks like someone started to pay attention and start moving folks out perhaps that weren't paying, later in the summer, like starting in July and going to the end of the year. So there's always a correlation, of all of that. I don't know, like, so I'm assuming that people moved out and that's where we saw the bad debt expense. You may have other thoughts on that, but the important thing in looking at these is to really, contemplate some of the things that we talked about and just being aware and looking at the numbers and letting the numbers help you to see the story. But as Katisha was saying, these are some of the things that you can see in sort of your, view from your office. It's really important to be out at the property and have the view of what's going on at the property as well. Any other thoughts on this or any questions that you have for us? No? Okay. Well, we are at the end of our series. I thank you so much for joining. As Katisha had said before, we really enjoyed doing this a couple of years ago. We're very excited to be asked back to present it to, a new group of folks. I know it's hard to make this much time fit into your schedule. So we recognize that it was a sacrifice, but definitely an investment. I hope you feel it was an investment in, expanding your knowledge and connecting. And we just appreciate all of you. If there's anything that we can do to, to help you or answer questions going forward, let us know. Nicole is going to work to see how we can gather some contact information for folks who do want to share their contact information. So she and Melissa will work on that. Melissa, did you or Katisha, do either one of you want to jump in and say anything else before we sign off?
No, other than thanks so much for joining, and we hope to see you again.
Thank you all. I've learned so much. I appreciate this. Thank you.
We're glad to hear that. Thank you, Dawn. All right. Well,
Thanks,
take care,
Carolyn.
everyone. Yeah, thank you, Katisha. A pleasure as always.
Yes, it is. Thank
Bye,
you. Have a
everyone.
good
And
afternoon.
yeah, enjoy the upcoming holidays. I can't believe it's the end of the year, but here we are.
I
So
know.
enjoy and get off to a good start next year with all this good information.
Yeah. Thanks, Carolyn.
All right,
Thank
take
you.
care, everyone.
Everyone.